I'm going to show you how the incoming Trump administration can use bank deregulation in order to get all of the same effects of the Fed's quantitative easing without ever involving the Fed at all. So first, what is quantitative easing? Quantitative easing, or QE for short, it is just a euphemism, a fancy way of saying debt monetization. And if that phrase, debt monetization, sounds to you at all like debt turning into money, that's because that's pretty much exactly what is going on there. So how does the debt monetization process normally work? Step one in the debt monetization process is creating debt. This is done by the government when they borrow money. They issue something called a treasury bond, and it is essentially an IOU that they sell to the highest bidder. That IOU gives the buyer the right to get dollars back from the government at some point in the future. It is debt, it is a contract, it is a bond. Typically, these treasury bonds are sold to financial institutions like banks, and what the bank will then do is take that contract, that piece of paper, that IOU from the government that guarantees them dollars in the future, they'll turn around and they'll sell that IOU to an entity like the Federal Reserve. In this case, the Federal Reserve will print dollars into existence in order to purchase that IOU from the bank. So the newly created dollars and the IOU change places. Now that IOU is held by the Federal Reserve. So the government owes those future dollars to the Federal Reserve instead of to the bank. But the bank is now sitting on a fresh pile of new cash that they can go do something else with. And in many cases, they turn right back around to the government and loan it out again to rinse and repeat the process. So that's how the process of debt monetization works. But what are the effects of debt monetization? Well, usually it results in an easing or a loosening of financial conditions generally. This happens for a number of reasons. Reason number one is that the government is accessing newly created dollars in order to spend into the economy. This influx of new dollars circulates through the economy, increasing economic activity. Yes, this causes inflation, but as long as the official inflation numbers don't show too high of readings, then they keep on pressing the money printing button. The other reason why this generally loosens financial conditions is because it keeps the interest rates of the debt low. Interest rates and the price of bonds are inversely correlated, because if I borrow $100 from you at a 5% interest rate, I owe you $105 back. But if somebody else comes in who has a money printer and they want to buy that debt from me, and let's say I really don't want to sell it, but they offer me $101 instead of the $100 that I loaned, well, I might just go ahead and sell that because I loaned you $100. I'm expecting to get $105 back in the future, or I could get $101 back right now. I might just do that and sell that debt. Well, the price of that debt went up from $100 to $101. I made money on that. But the person who bought that debt from me is still only going to get $105 back. So their interest rate is a little lower, a little under 4%, because they spent $101 to get back $105. And so when the price of the bond went up, the interest rate or the yield it paid went down. This is how all of debt works. So when you have somebody with a money printer who's injecting new money into the system in order to buy up debt, it's going to increase the price of all debt, which pushes down the interest rates. Or another way to look at it is that there is an artificially high demand for people to loan money to the US government because some of that money is coming from a money printer. That means the US government can borrow at artificially lower rates because there are more lenders, more dollars willing to be lent than there otherwise would be. And in normal financial conditions, when the government interest rates go down, that usually affects other interest rates as well, because the economy will look at the US government treasury rates as kind of a benchmark for what the risk-free interest rate is, and then add a risk premium on top of that for the type of debt. For example, if the US government 10-year treasury has an interest rate of 4.5%, then a mortgage rate might be 6 or 7%, because a lender could lend to the US government risk-free for 10 years and get 4.5%, or they could take on some additional risk and lend to a person to buy a house. Usually that debt's going to get repaid within 10 years, which is why they use the 10-year as the benchmark. So they'll add on a couple extra percentage points as the risk premium for that type of debt. And so if the government is getting lower and lower borrowing rates, then in normal conditions, everybody else is getting lower and lower borrowing rates as well. Okay, so we've put two pieces of the puzzle together. We understand what debt monetization is, and we understand why it has the effects of generally loosening and easing financial conditions. But how is it that deregulation by the incoming Trump administration could cause some of the same effects of debt monetization without actually using the Fed? Because we know this requires the Fed adding to their balance sheet by printing money to buy up debt. So how can we get that without the Fed's help? As it stands, banks are extremely regulated and highly limited on what they can do, what they can't do, and of the things that they can do, how much of it they can do. Even as something as simple as lending dollars to the US government, there are restrictions that cap how much money banks can loan to the government. Now, I want to make it clear. These regulations do actually make sense for one reason, and it's because banks have a license to print money. I'll explain why that matters in a moment. But first, yes, banks do actually create money out of thin air. That's how banks work. In a nutshell, here's how it goes. They take your dollar when you deposit your paycheck or something else. They then take your dollar and loan it out to somebody else. And then that somebody else puts it into a new bank account. Now, your bank account still shows that you have a dollar that you could go get at any time, and they won't stop you. But the key thing here is that the other person who got that loan and that dollar ended up in a new bank account, they also have a dollar that they could take out at any time. This is called rehypothecation, the fractional reserve banking system. It's also maturity transformation. There's a whole host of things going on here that are all wrong, but basically it all boils down to fraud. Because if you and everyone else at the bank go try and get your money that they say you can get at any point, it's not actually there. There will be a bank run and the bank will collapse, as we've seen a few times over the last couple of years. But before the bank run happens, before the panic sets in, you had $1, you deposited it got loaned out. Now there are $2 where there only used to be one. Banks have a license, a legal monopoly on creating money out of thin air through debt. Now, this is not how the free market works. In a completely free market, this would not be possible. A free market would mean there's no bailouts and there's also no regulations, and there's no laws that executives who took on too much risk can hide behind in court saying, hey, we followed all the laws, so the blow up wasn't our fault. In the free market, if a bank took your money and they told you you can have this dollar back whenever you want, and then they turned around and loaned that dollar out to somebody else, that's fraud. Because if you tried to go get your dollar, they wouldn't be able to give it back to you. Now, if you knew your dollar was going to be loaned out for a certain amount of time and you signed up and said, no, I won't take it back out, then that's one thing. But that's not how banks operate today. So in the free market, if a bank committed fraud and there were any losses from it, the bank would be shut down and massive awards would be rewarded in court, and the people who are running that bank would never be allowed in banking again, and people would be very careful about who they trusted their money with, making sure that it was all done above the book, that there was not excess risk being taken, and the banks themselves, they would see a bank that went down from a bank run and the fraud and the losses that happened in a result, and all the other banks would say, whoa, we're not getting anywhere near that. We're not going to participate in anything like that. So the risk of blow up would regulate banks by itself. But we don't live in a free market, especially regarding banking. Banks have a legal license to commit this fraud, to print money into existence, and then to take excess risk with your money. Now, these risks can obviously blow up and cause massive losses. Again, we've seen that happen recently. And so, because the government gives them a legal license to commit fraud, there are regulations, fences put up in place to say, hey, just don't commit too much fraud. Just don't take too much risk while you're committing this fraud. And so as long as banks do have the ability to print money into existence and to commit fraud through rehypothecation and fractional reserve banking and maturity transformation, it is totally sensible to have restrictions on how much risk they can take. But these regulations can cause unforeseen consequences and can absolutely make it more difficult for banks to profit from normal banking activity. Many times this can push banks to seek out alternative ways to make money that many times have hidden risks that offer their own set of blow-up risk. But what if an incoming presidential administration decided to deregulate the banks and remove some of these restrictions in order to broadly ease financial conditions? If the phrase deregulating the banks reminds you of Clinton repealing the Glass-Steagall Act and the ramifications of that potentially having an influence on the great financial crisis, I wouldn't blame you. But regarding financial conditions getting looser and easier without the Fed's help, what would happen if you made some key changes with rules regarding banking? Well, the first thing that could happen, and you could view this as a positive, is it allows banks to do more regular banking activity again, which would allow them to be more profitable in normal banking activities. You can see from this chart here that there has been an absolute explosion in private credit over the last couple of years. This has been extremely profitable for private lenders, and there has been absolutely massive demand for it from the borrowing side. This is one of those areas that banks have not been able to address, even though they should be able to, simply because of the fences, the regulations that have been put up around banks. Having more lenders be able to participate in the exact loans that private credit has had such a boom in recently would allow rates to fall and more borrowing and more spending to happen, contributing to more economic activity. The second thing Trump could do is make changes to the FHLBs. The FHLBs are regulated by the Federal Housing Financing Authority, which is underneath the president. They can provide cheaper funding to banks, and this could primarily have an effect on making mortgage rates cheaper because it would allow more and easier purchasing of mortgage-backed securities, something that the Federal Reserve is no longer buying any of. If you want a deeper dive on this topic, I highly recommend signing up for Joseph Wang's premium newsletter service on his website, fedguy.com. That's FEDGUY.com. Not a sponsor, he's just a pretty smart guy. I pay for his premium service myself. He's a former Fed insider, and I enjoy his research. I recommend it. Now, the third thing that we could see, I've gone into great detail. I call it stealth QE through the banking system. Now, this would require a little bit of coordination with the Federal Reserve, but no actual easing from the Fed itself. There are multiple regulators over the banking system, and the Federal Reserve is a big one. One of the things the Federal Reserve regulates is how many treasuries banks can own on their balance sheet. Now, this is because something could happen, like we saw over the last couple of years, which the value of those treasuries goes down after the banks buy them. So you still have to look at them as some sort of a risk asset because the bank might not be able to hold on to them until maturity. If there is a bank run, they might have to sell those treasuries at a loss, and they might not have enough to cover all the deposits. And so right now, banks do have a limit on how many treasuries they can own. But the Federal Reserve has made some changes and opened up some facilities over the years that kind of change the way that treasuries can work for a bank. Through things like the Bank Term Funding Program, the BTFP, if the Fed decided to open that back up, the discount window, the Fed's involvement in the repo market, most of the risk associated with banks owning treasuries is kind of eliminated today, which means that functionally banks should be able to treat treasuries as if they're just reserves, because when push comes to shove, they could always turn around and sell those treasuries to the Fed, at least temporarily, for full price. That means even if they loaned $100, and right now if they could only sell that thing for $90, they could turn around to the Fed and sell it for full or almost full price. If that gap is fully bridged, then there would be no reason to tell banks that they could only hold an artificial cap of treasuries on their balance sheet. Banks would be free to print an infinite amount of money to loan to the US government because it would be essentially risk-free just for the banks. This would mean that quantitative easing or debt monetization that the Federal Reserve normally does would be opened up to pretty much any bank to do themselves. And even with the Federal Reserve reducing its balance sheet, maybe even raising interest rates, wouldn't matter because the entire banking system would be able to do the job of QE and debt monetization without the Fed. Now, all of these would likely lead to at least some inflation of goods and services, but more likely would cause increased asset price inflation. And if you would like me to help you apply ideas like this to your portfolio so that you can grow it and protect it during times of crisis, like if there's ever a big risk event from these banks engaging in too much risk after this deregulation, go ahead and click on the link in the description below. Join my program. Would love to see you there. As always, thanks so much for watching. Have a great day.